Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Now, think about the stimulus package and then think about money supply. I can remember where back when every Thursday when they reported money supply, the markets would move on this money supply report. Now they've changed the reporting now and they keep a lot of that hidden from us, but it's pretty easy to guess that the short-term result is more available dollars. Now the short-term effect of that, it should ease the credit crunch. I think that's what's the market's telling you now, that credit is going to fall a little bit, and you've got to have credit for the market to expand. I know that we've had a deleveraging going on in our housing industry. We had a deleveraging going on in our businesses, and a lot of people that were living off credit, for example, have found out that it's not readily available, all the way down to the auto industry, and you know, there's just been problems throughout every area. I saw a report the other day. They were talking about RVs, and the RVs, there's demand for them, but there's no credit for people to buy them. And so I think that when these problems are solved in the short term, then you start seeing the economy settle, and you start seeing the economy strengthen. And that is the near-term effect of the stimulus that's coming out. The long-term effect is once it gets going and moving, how are you going to slow it down? And, you know, we're not even close to that right now, so you got a little time to take advantage on the fact that there are some bargains out there, and there will be the ability to make some money. The cycle and when it changes, that's what traders are good at, and we can show you some ways that can give you some warning signs when that turn's going to come. I like this statement. Everyone likes the idea of having more dollars personally. You know, if you know, they say that, you know, what's the difference of a recession and a depression? I guess the depression is when you lose your job, but sort of to the sense that when you have more dollars, you feel enriched, you feel affluent, and you feel able to spend. I know that a lot of people, and I'm not just in all different segments of the population now, are looking at how they handle their own personal dollars. And I think that tightening, I think the savings rate here in the U.S. will start back. It's been declining for years. I think you're going to see people saving money. But you got to understand that it will expand again, and when it does expand, there will be a short-term effect of stronger markets. Now, if you think about the British government and you think about the U.S. government, and you go back in history, you know, we came really from the British over here, and we had the war, and we actually separated, and we became a separate country, but we still speak the same language, and we still act the same way. Very close, you know, our ancestors are really from that area, and we think the same way. So we're sort of acting the same way during this credit crunch. We're doing the same things. You know, the Japanese, for example, are ahead of us, and they've already been there. And the Bank of Japan and the yen have been doing this for a long time. But what about the Aussies? Aussies seem to be in a little bit better shape if you look at their economy and look at what's going on there, and they do have room to open up the spigots a lot more than the U.S. and the British government. The one central bank and the currency that is not like those is the ECB and the euro, and I think the euro is really the currency you got to keep your eye on. I think you ought to have some diversification into the euro, regardless of what country you live in. And I've been watching the euro since it was about 88 to the dollar, and now it's up to around 135, and so it's had quite a movement, but I'm not sure it's over. I think it's a stable currency, and I think if I had to define the U.S. dollar, I'd say it's in a bear market, and the euro currency is in a bull market. If you just had to look at it from a longer-term aspect. And you can see how the flow of funds goes to the stronger currency, and that's what you're seeing in the euro. It's just a fundamental reason that people do that, because the euro is the strongest of the currencies, and it's gained ground on the British pound. When crude oil was rocking around about 140, 150, you had a little different relationship. And so I think you're seeing, with crude prices down, an effect on the British pound. And I think you're seeing the other effects of the weakened economies in around the globe having strength going into the euro. And it's pretty easy to see if you just look at a chart, or you look at where it was a year ago, where it was 2 years ago, or where it was 3 years ago. That trend is solid, and it's in place. All right, strategies. All right, let's just take a fundamental view here. I believe, and in my opinion, the US dollar will get weaker. I believe, in my opinion, that the euro currency will get stronger. So how would you make money if that was your strategy? Because that to me, I tell people this all the time, you got to have a strategy that fits the situation. So if you got a strengthening euro and you got a weakening US dollar, then you would want to be long the euro and short the US dollar. Now remember, the EUI is based in U.S. currency, so that it sort of throws you as a kicker here when you see U.S. dollar/euro. It's showing weakness. That situation is going to continue, and you're going to see the EUI listed on the ISE showing weakness, because that's the way it's setting up, meaning the euro's going up, the dollar's getting weaker. Now here's a little difference, and it's a little side difference here. The ECB affects economic stimulus. It has responsibilities not to the various European currencies, but its responsibilities are to the support of the euro. And that puts it in a unique position versus other currencies. And another reason I believe the euro will continue to strengthen during these times where you're seeing what's going on fundamentally. Here's some rates that, the key rate ECB is 1.5%. They're expected to cut the key rate, and if they started rising the rate, then you would see inflationary concerns, but you won't see that in this environment. What you have right now is you're trying to get the markets to move, and when you do that, you have to drop those rates to stimulate spending. And people start chasing where the yields are, and those yields give extra money to stimulate the economy, and that's what's going on right now.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.